Gap insurance in the inflated car market. Hello, it's Elizabeth from the Homework Guy team. If you missed the big guy, stay tuned to our community page for updates on Kevin's recovery. Your outpouring of prayers and support has been tremendous and appreciated. Today's menu includes: what is gap insurance, who needs it right now, and which company offers the best policy. Remember, you can use the chapters feature below to fast forward to the information you're looking for. Let's roll. So what is gap insurance and how does it work? When you buy or lease a new car or truck, the vehicle starts to depreciate in value the moment it leaves the car lot. In fact, most cars lose 20% of their value within a year. Standard auto insurance policies, meaning comprehensive and collision, cover the depreciated value of a car. In other words, a standard policy pays the current market value of the vehicle at the time the claim is made. In the event of an accident in which you've totaled the car, gap insurance covers the difference between what a vehicle is currently worth, meaning the actual cash value covered by your standard insurance, and the amount you actually owe on it. And in case you're new to the Homework Guide channel, you should know that gap insurance sold by a car dealer finance office is steeply overpriced, to say the least. Car dealers charge customers between $500 and $1,000 for their gap policies. Most gap insurance policies bought directly from an outside insurance provider, alongside collision and comprehensive coverage, adds only about $20 a year to the annual premium, according to the Insurance Information Institute. Who needs gap insurance? Gap insurance makes the most sense for people who put as little money down as possible and choose a long payoff period. For a few years, they owe more on their car than its current value. It also makes sense for those who lease rather than purchase a vehicle. Some dealers claim that you have to have gap insurance to write a lease, so do some checking, verify with the manufacturer itself if you're not certain. You may be able to skip gap insurance if you made a down payment of at least 20% on the car you bought, or if you're paying off the car loan in less than 5 years. Here's the important part to remember if you do get gap coverage. Just until your loan balance doesn't exceed the car's value. Put it on your calendar to call your bank every 6 months, for example, and ask what the actual cash value of your vehicle is compared to your loan payoff amount. What I just shared will always be true of gap insurance. Now let's take a look at the current car market and see if it's a good decision for you. If you're a smart car buyer, you always put 20% or more cash down on a vehicle you're financing. Right now, that 20% is going towards the loan-to-value ratio, just to squeeze it within the range of possible finance. Nowadays, you can't get a car loan when cars are over MSRP without putting 20% cash down. See our previous video called Top 7 Things Not to Do at a Car Dealership for more information. Here's a car calculator so you can see what happens. Let's say you're buying a new car priced at $40,000. The actual cash value that the bank says it's worth is only $37,000. Thank you, inflation. You put 20% down, which is $8,000. With 5% interest on a 5-year loan, the amount you'll pay over the course of the loan is $34,800. However, your car isn't worth $40,000. It's only worth $37,000. When you drive off the lot, your car instantly depreciates to $32,000. If you got in an accident that same day, you'd owe $2,800 on the vehicle after insurance totaled it and gave you the cash. If you have gap insurance, they would cover that additional $2,800 of the loan payments remaining. Your loan-to-value ratio on day one is $34,800 to $32,000, which is 109%. As far as loans are concerned, car loan terms were never meant to be more than 4 years, which, by the way, happens to be a longer term than most people actually keep their cars. Should you still be making payments on a car that you now want to get rid of? No. If you need to buy a new car, plan to keep it in good running shape for many years to come. And if you finance a vehicle for over 3 years, you'll need gap insurance during the first few years of that depreciation. If you were to trade in a car that you owe on, you'll likely have negative equity, like we talked about, where the loan balance is higher than the actual car value. I realize that some car dealers are offering top dollar for trade-ins right now, but it also means they're expecting top dollar for their new vehicles. It's not a win-win situation for car buyers, so be savvy before you pull the trigger. Many of you have commented with the great deals you've gotten, and we're so proud of you here at the Homework Guide team. Keep up the good work and keep sharing those stories so other people can learn from you. So if your car is not worth more than you owe on it right now with inflation, you do not belong in the market to purchase a new car. Another thing to watch out for that increases the loan-to-value ratio is fake fees. Car dealers are putting in more and more fake fees than ever before. Here's their argument. If you don't buy the car from us, somebody else will. Well, when inventory is low, you are kind of stuck with these bozos. It begs the question of consumers right now. Is that the best you can do? Check out our recent video, Should I Fix or Sell My Car? We suggest that more often than not, keep your old car running and reliable and save your money. To make sure you're paying the right price for a new car, start by calling your own bank or credit union and asking what the actual cash value of the car is and how much they'd be willing to finance it for. Call multiple dealers or simply go to the manufacturer website and do a new car build on the site. See our video, visit the car dealership's fleet manager if you want to work face-to-face with someone to actually order a new car. Finally, consider buying a lower cost vehicle and just paying 100% cash. Be smart with your money and skip the gap insurance discussion altogether. Yes, gap is cheap, but the side effects from needing it are not. So here are the top-ranked gap insurance policies according to insuranks.com. Progressive, $60 a year. State Farm and Allstate, between $15 and $55 a year. Nationwide, between $20 and $50 a year. And CarMax, $30 a year when purchased directly from the company. Alright, if you appreciate our video today, consider giving us that great big thumbs up, and please always remember to comment on our videos and share them with your family and friends. Comments really matter because they help boost our searchability and lead others out there to reach great Hallmark Guy content too. The entire Hallmark Guy team is here to represent you, the car buyer, and that's what we love to do. Thanks everyone for coming back. We'll see you on our next video. As Kevin always says, you guys rock. I'm the amazing Elizabeth. Gotta go.